Right now, millions of Americans are not just nervous, they're overwhelmed. Stocks are sliding. Bitcoin is dropping fast. Gold and silver are swinging wildly. And for the average person watching this unfold, it feels like nothing is safe anymore. When markets move this quickly, uncertainty spreads faster than information. People don't know whether to hold, sell, or run for cover. And that emotional confusion is exactly what turns normal market stress into personal financial panic. This is not about charts anymore. It's about confidence. And confidence, once shaken, affects every decision people make with their money. Here's the reality most headlines won't explain clearly. When markets fall sharply in a short period of time, the fear isn't just about portfolios. The fear is about jobs. Stock prices don't fall in isolation. They signal tightening conditions. And when conditions tighten, companies respond the same way they always do, by cutting costs. That means hiring freezes, layoffs, division closures, sometimes entire businesses shutting down. Markets falling is one thing. The real concern is what comes next for the real economy, and that's why people are so anxious right now. We're already seeing early signs of this pressure. Technology companies, crypto firms, and growth-heavy sectors are scaling back aggressively. When asset prices fall, capital dries up. When capital dries up, companies stop expanding. That's not speculation. That's how modern corporate finance works. And this is why market declines hit harder today than they did years ago. The system is more leveraged, expectations are higher, and tolerance for losses is lower. When prices move fast, businesses don't wait for clarity. They act defensively. Crypto is amplifying this stress. Bitcoin dropping sharply doesn't just affect traders. It affects sentiment across the entire risk spectrum. When a highly visible asset falls 10, 12, 15% in days, it sends a message that volatility is back in control. And volatility creates forced decisions. Companies reduce exposure. Investors lock in losses. And individuals who bought into long-term narratives suddenly feel betrayed by short-term reality. That emotional shock is powerful, especially for people who entered near the top, believing prices could only go higher. This is where personal stories start to matter. People didn't just speculate with spare cash. Many moved serious money, retirement funds, savings, long-term capital, and now they're watching months or years of gains evaporate in days. That kind of loss isn't just financial, it's psychological. When people feel trapped in losing positions, they stop thinking strategically and start thinking about escape. That's when bad decisions happen. Not because people are irrational, but because fear compresses time. Everything feels urgent. Everything feels final. And here's the dangerous part. Panic selling rarely happens at the top. It happens after damage is already done. When people say, "I can't take this anymore," that's usually not a market signal. It's a human one. It means uncertainty has overwhelmed patience. History shows this repeatedly. The most painful losses often come from emotional exits made during periods of peak fear, not from the initial downturn itself. That doesn't mean markets can't fall further. It means reaction matters more than prediction. At the same time, it's important to be honest. This fear isn't irrational. People are worried about losing jobs, paying bills, affording food, keeping their homes. When markets fall alongside economic uncertainty, preservation becomes the priority. People aren't trying to get rich, they're trying to survive. That mindset explains why selling accelerates across everything at once. Stocks, crypto, even precious metals. When fear spikes, liquidity matters more than logic. And that's a very human response. This is where perspective becomes critical. Markets have always moved in cycles. Fear peaks before clarity returns, but the timing is never obvious while you're living through it. During past crises, the same emotions dominated headlines: panic, confusion, anger, regret. And yet, those periods also created the foundations for long-term opportunity. Not instantly, not easily, but eventually. The difference between those who recovered and those who didn't wasn't intelligence. It was behavior under stress. One of the biggest mistakes people make during volatility is assuming that action equals control. Selling everything feels decisive, but it often locks in damage. Doing nothing feels irresponsible, but sometimes restraint is the most rational choice. The goal in moments like this isn't to predict the next move. It's to avoid irreversible decisions made under emotional pressure. Once capital is gone, optionality disappears. And optionality is the most valuable asset during uncertain periods. Another mistake is assuming that every downturn signals a collapse. Markets correct, markets overshoot, markets scare people out before stabilizing. That doesn't mean this moment isn't serious. It is. But seriousness doesn't automatically mean catastrophe. It means selectivity matters more, quality matters more, balance sheets matter more. and patience becomes more valuable than conviction. Fast money suffers in slow recoveries. Slow money survives. Fast crashes. This is also why comparisons to past crises come up so often. People remember 2008. They remember 2020. But what they often forget is what happened after. The fear felt endless at the time. The clarity came later. And those who avoided panic decisions were the ones who had flexibility when conditions improved. That doesn't mean everyone should buy aggressively. It means everyone should slow down mentally before acting financially. Right now, the smartest move for most people isn't bold bets or dramatic exits. It's assessment. Understanding exposure. Understanding time horizon. Understanding whether assets were bought for speculation or long-term ownership. Those are very different strategies, and confusing them leads to regret. Volatility exposes mismatches between expectations and reality. Fixing those mismatches requires thought, not speed. Another truth people struggle with is that recovery is uneven. Some assets bounce quickly, others take years. Some never return to prior highs. That's normal. Markets don't reward hope, they reward structure. Assets with cash flow, resilience, and real utility survive stress better than narratives and momentum. That distinction becomes painfully obvious during downturns, which is why fear feels so personal. It forces reassessment. For those worried about the next few months, it's okay to focus on stability first. Liquidity matters. Emergency buffers matter. Mental clarity matters. You don't need to win the next rally to protect yourself from the next shock. Survival is not failure. Preservation is strategy. And ignoring that reality leads people to take risks they don't actually want. Only risks they feel forced into. It's also important to understand that uncertainty isn't going away quickly. Volatility is likely to be more frequent, not less, over the coming year. That doesn't mean constant crashes. It means faster rotations, sharper pullbacks, and shorter windows of calm. Preparing mentally for that environment is just as important as preparing financially. Expectations shape decisions more than charts do. No one can tell you exactly what happens next. Anyone claiming certainty is selling comfort, not truth. What we do know is this. Panic creates poor outcomes, patience preserves options, and clarity usually arrives after the hardest decisions are already behind you. Markets don't punish fear, they exploit it. Staying aware of that dynamic helps prevent becoming part of it. This moment will define how many people approach money for years. Some will exit permanently, burned by volatility. Others will adapt, learn, and adjust their strategy. Neither path is easy, but only one allows recovery. You don't need perfect timing, you need discipline under pressure. And that discipline starts with not letting short-term chaos force long-term regret. So take a breath, step back, separate emotion from strategy. Volatility is loud, but it's temporary. Decisions made in panic tend to last much longer than the panic itself. Stay deliberate, stay patient. And remember, what you do during uncertainty matters far more than what you do during calm. This period will pass. The question is how you come out on the other side.